I've reviewed countless equipment finance applications in my career. I see the same 10 mistakes that kill deals every single time. If you're an established business owner, this video could change everything about your company. I'm Brandon Keeling, and today I'm going to show you exactly what lenders look for, why deals get declined, and how to structure your next deal so you never get surprised again. Let me start with the most important issue that I see with business owners. They don't understand what is going to be required of them. This is the biggest thing that kills most applications. You need to understand what is going to be required from your company. Things like, how much time in business do you have? Do you have comparable debt? What is your business credit score? What is your personal credit score? Are you profitable? What is your net income? Are you cash flow positive? How is your financial presentation? These are the factors that need to be considered before submitting your application for financing. This is the most important point. It's your understanding of what the requirements are. And number two, the second biggest mistake that I see is companies willing to wait weeks for a credit decision. Listen, sometimes companies need to move fast when they buy equipment, whether that is a new hydrovac truck, a new production line, a manufacturing or construction equipment. Traditional banking institutions are not built for speed. A new contract is sometimes dependent on how fast you can move. Otherwise, you're going to get crushed by your competition. Here's the risk that I see. You submit a deal to your bank and they schedule you with the credit committee next week. Meanwhile, your competitor buys the equipment and funds the vendor within 24 hours by making one phone call. The reality is, time kills deals. A specialized lender can fund a deal within 24 hours, unlike traditional banks that take weeks. But speed means nothing if you're presenting your deal wrong to lenders. And here's mistake number three that could be costing you thousands. You don't know how to package your deal for lenders. Lenders penalize incomplete packages with slow approvals, restrictive terms, or outright declines. Here's what a clean package looks like: 2 to 3 years financial statements, current interim financials, equipment specifications and quotes, and proactive explanation on any credit issues, and obviously a clear business purpose for the equipment. And here's an insider secret: specialized lenders will approve stories and not just the numbers. But this goes back to understanding what the requirements are and how are you presenting the financing package to the lender. If your tax returns show a loss for the year, explain why. If you have contract that's tied to a specific asset, make sure that you provide the documentation. Again, financial presentation is everything. Now, here's where most business owners completely miss the mark. Mistake number 4 is thinking that interest rate is the only thing that matters. I see companies shop for equipment financing repeatedly. They think that it's all about the interest rate. It's really the wrong approach. Structure is everything. Things like term length, advance rate, balloon structures, seasonal payment options, and prepayment flexibility have a massive impact on your cash flow and your balance sheet, and ultimately the long-term financial impacts for your company. Here's an example. Lender A offers 8% at 60 months with 100% financing. Lender B offers 7% at 48 months with 10% down and a balloon payment. Which is better? Depends on your cash flow, your growth plans, and your exit strategy. The truth is, structure beats rate every single time. And this is something that only a specialized lender can help walk you through. A slightly higher rate with a better structure can save you tens and thousands in cash flow and give you flexibility for future equipment acquisitions. And mistake number 5, you think that your bank is your only option. Most business owners believe that their only option is to finance equipment with their bank, and they're missing an entire universe of specialized equipment finance companies that operate with a different underwriting criteria, that can approve deals that banks decline, and offer structures tailored to equipment-dependent industries. The reality is your bank sees equipment as risk, and a specialist sees it as a revenue-producing asset. A construction equipment specialist understands equipment values, seasonal cash flow, and project-based revenue from a piece of equipment. A manufacturing equipment specialist understands new production line, includes soft costs that are often too high for a bank to be comfortable with. They understand long-term production builds and the training and the commissioning that must be a part of the total financing package. It's a different process that will produce different results for your company. Now let's talk about the mistake that's quietly destroying your bankability. Mistake number 6, your tax strategy is killing your financing approvals. When your CPA minimizes your taxes, it's great for April 15th, but terrible for a loan application. Things like accelerated depreciation early or large owner distributions and expense maximization make your business look weak on paper, even if operations are strong. A business showing $100,000 in net income on $10 million in revenue looks very different to a lender than it does your accountant. Plan your financing before you need it. If you know you're going to need equipment this year, structure this year's taxes with bankability in mind, and work with your CPA and your equipment finance professional together. And mistake number 7, you don't understand what comparable debt means. Listen, lenders look for prior equipment financing experience with similar dollar amounts for similar types of equipment. A business that has never financed equipment before looks riskier than one with a clean payment history, even if the first business has higher revenue. The catch-22 is you need equipment finance experience to get equipment financing. Start smaller, build a track record. A $50,000 equipment loan paid perfectly over 12 months makes your next application much stronger. And remember that most lenders will look for 50% comparable debt, meaning if you need $500,000, they want to see that you financed $250,000 in the past. Think of this as a trade line on your business credit report. The higher the credit line, the better. And that's mistake number 8. You're applying to lenders who will never get your deal approved. Not all lenders are the same. Some have geographic restrictions, minimum revenue requirements, and industry preferences and deal size limits. You waste weeks submitting deals to lender that will never get your deal approved. Every rejected application generates a hard inquiry and damages your credit profile. The strategy here is match your deal with a lender that has an appetite for your industry and your assets. A lender that you pre-qualify before applying. What assets do they prefer? Do they have experience in your industry? What other companies have they worked with? Build a relationship with a lender who is familiar with your business, your operations, and your growth objectives. A lender that can move quickly with minimal paperwork. And mistake number 9, companies drawing from their business credit line to upgrade equipment. This absolutely destroys your liquidity. We see companies all the time tie up a revolving credit facility in a long-lived asset, ultimately removing the safety net you need for payroll and operations. The consequence is you turn your flexible credit line into fixed debt. Plus, you often trigger bank covenants when your line of credit stays maxed out. This is the perfect opportunity to diversify your capital stack. Bring in a specialized lender that understands your business, your capital needs, is flexible, and can complement your primary banking relationship. And mistake number 10, you only think about financing when you need it. Companies that grow sustainably treat equipment financing as a capital strategy, planning bankability, credit profile, and lender relationships before they need them. Our suggestion is having a proactive approach. Build your financing capacity before you need it. Plan for the year. Have your CapEx budget planned. Establish a relationship with a lender that can set you up with a line of credit that won't affect your primary banking relationship or your main operating lines. And here's the bottom line. Every one of these mistakes is fixable, but you need to work with an equipment finance professional. If you're planning to buy equipment this year, don't make these mistakes. Work with the lender who can guide you through the process correctly the first time. And if this video helped you understand equipment finance better, subscribe for more content. I'm Brandon Keeling, Middle Market Equipment Finance.